Every year, millions of investors pour money into the same familiar places: stocks, crypto, maybe some real estate. They follow the crowd, watch the same headlines, and bet on the same trends. But the investors who actually build generational wealth, they don't follow the crowd. They find what the crowd is ignoring. In 2026, there is one asset class that has quietly outperformed nearly everything else, survived multiple economic cycles, and is still flying under the radar of the average investor. It is not Bitcoin, it is not the S&P 500, and it is definitely not whatever stock went viral last week on social media. The most overlooked asset class right now is commodities, specifically industrial and precious metals like silver and copper. And by the time most people catch on, the smart money will already have made its move. Why commodities are being ignored? Here is the strange part. Silver did not just perform well last year, it more than doubled 140% in 2025. Copper also had a massive run. Gold climbed nearly 64%. These were some of the strongest returns across all major asset classes. And yet, when most people talk about investing, commodities barely come up. Part of the reason is psychological. Stocks have a story. Tech companies have founders' products, press releases, and Twitter followings. Silver is just silver. There is no charismatic CEO. There is no earnings call to watch. It does not trend on financial forums the same way a hot AI stock does. So most retail investors overlook it entirely, but the billionaires are not overlooking it. A recent survey of the world's wealthiest investors found that they are increasing exposure to hard assets, and the macro signals behind that decision are hard to ignore. Inflation concerns remain persistent in many regions. Global central banks have been buying gold and metals at elevated rates since geopolitical tensions began escalating a few years ago. And now there is a brand new demand driver that most people are not connecting to commodities at all: artificial intelligence. Every AI data center requires enormous amounts of copper wiring, silver contacts, and industrial metals to function. The build-out happening right now across the United States, Europe, and Asia is one of the largest infrastructure investments in modern history. NVIDIA's Jensen Huang has described this as a once
mistakes, and I make a lot of them, and some of them
in a generation infrastructure cycle. But while investors race to buy NVIDIA stock, few are paying attention to the raw materials that make all of it physically possible. Silver is a remarkable electrical conductor. In fact, it is the best natural conductor of electricity known to science. That makes it irreplaceable in electronics, solar panels, electric vehicles, and AI hardware. Supply, on the other hand, has not kept up with demand. Mining output is constrained, new deposits take years to develop, and recycling cannot fill the gap. This is a classic demand surge meeting a supply ceiling, and historically, that combination leads to significant price appreciation. Copper tells a similar story. It runs through every wire, every motor, and every data center wall. As global manufacturing shifts and AI infrastructure expands, the demand for copper is only increasing. Yet most everyday investors still see copper as an old-world industrial commodity, something for construction workers to care about, not wealth builders. The emerging market bond story nobody is talking about. If commodities are the most overlooked hard asset in 2026, then emerging market bonds are the most overlooked financial instrument. This one is even more puzzling because the data is exceptionally clear. Emerging market bonds have outperformed developed market bonds on both an absolute basis and a risk-adjusted basis for over 2 decades. That is not a recent trend or a lucky streak. That is 2 decades of superior returns, and yet investor positioning in this space remains historically light. Most portfolios, from everyday savers to institutional funds, are dramatically underweight here. Why? Partly because the name itself carries a stigma. Emerging markets sounds risky. It sounds volatile. It sounds like something happening far away that is hard to understand. And so, investors default to the familiar US Treasuries, investment-grade corporate bonds, and developed market fixed income, even when the numbers consistently tell a different story. Here is what makes this particularly interesting in 2026. Many emerging economies are on completely different fiscal and demographic paths than the United States. Several have been ahead of the curve in cutting rates and managing deficits. Inflation in a number of these markets has moderated significantly. Central bank flexibility is increasing, and starting yields in these bonds, often sitting above 6%, compared to roughly 3% for the global aggregate index. Mean income alone can drive strong returns even without major price appreciation. Ray Dalio, the founder of Bridgewater Associates.
You've made the most of it. You've squeezed the most out of life. And look back.
And one of the most studied macro investors in the world, has long argued that true diversification means owning assets that move differently from each other. Most American portfolios are overwhelmingly U.S.-centric. When domestic markets face headwinds, whether from Fed policy, trade disruptions, or political uncertainty, those portfolios have nowhere to hide. Emerging market bonds provide exactly the kind of genuine diversification that most retail investors are missing. Interestingly, foreign developed stocks showed this same dynamic in early 2026. While US equities struggled, international stocks from developed countries surged by over 6% in February alone, leading all major asset classes. Investors who had diversified globally were insulated from domestic volatility in a way that purely domestic portfolios simply could not match. The lesson applies directly to bonds as well. What smart investors are actually doing. The pattern is becoming clearer when you look at what the wealthiest and most strategic investors are actually doing, not what they are saying in interviews, but where they are actually allocating capital. Small-cap stocks are another area drawing renewed attention from sophisticated investors. After years of being overshadowed by mega-cap tech, smaller companies are trading at historically low valuations relative to large caps. Vanguard's chief economist Joe Davis has pointed out that the long
And even if you're bullish on AI, you think it's going to transform the labor market, it's going to raise corporate earnings,
term winners from AI may not be the headline technology names. Companies in healthcare, finance, and manufacturing that use AI to become more productive, without carrying the stretched valuations of big tech, could quietly deliver superior returns. This is actually the same thinking that guided Warren Buffett during many of his greatest investments.
People find other things in other fields because they just love looking for it. A biologist looks.
He famously built Berkshire Hathaway not just through tech or flashy assets, but through quiet, undervalued businesses that the market had simply forgotten to appreciate. The principle is timeless. The best opportunities are rarely the loudest ones. Gold equities tell a similar story in 2026. Gold mining stocks have historically been some of the most undervalued ways to gain leveraged exposure to rising gold prices. The total market cap of gold equities globally sits at around $1 trillion, a fraction of broader equity markets. Yet these companies are generating strong free cash flow, funding dividends and buybacks, and offering direct leverage to gold prices that are already elevated. Analysts watching this space believe even a modest rotation out of crowded tech positions could trigger a major revaluation. So what should the average investor take away from all of this? The answer is not to abandon stocks or ignore what is working. The market always has its winners, but portfolio construction in 2026 demands more than just owning the S&P 500 and hoping for the best. US large-cap stocks are not cheap. Tech concentration in index funds is at historic highs. A third of the S&P 500's weight is tied up in just 7 companies. That is not diversification. It is a concentrated bet with a diversification label on it. The investors who will look back on 2026 as a pivotal year will be those who had the discipline to look beyond the obvious. They bought silver when it was still being dismissed as a relic. They added emerging market bonds when the yields were compelling and the crowd was not paying attention. They explored small caps and international equities when everyone else was chasing the same AI narrative. The most overlooked asset class is not hidden. It is right there in the data, in the research, and in the behavior of the world's most sophisticated investors. The only question is whether most people will notice it before the opportunity narrows. The biggest wealth transfers in history have never happened because people followed the crowd. They happened because a few people studied the crowd and then quietly went the other way.